If someone told you your debt had been written off, you might feel relieved. You might think the problem is over, that the bank has moved on, that you are finally free. But here's what most people don't realize. A write-off has nothing to do with whether you still owe the money. And that gap between what people believe and what is actually happening, that gap has consequences. This is one of the most persistent financial myths. People hear the words written off, sometimes from a friend, sometimes in a conversation, sometimes even from someone who should know better. And they walk away believing that the debt is gone. So they stop engaging. They stop responding to contact. They assume the chapter is closed. And then months later, sometimes even years later, they apply for a new home loan, a car loan, or a new credit card. And something comes back, something they thought was actually finished. That is when the confusion becomes expensive. Understanding what written off actually means, and more importantly, what it does not mean, is not complicated. And that is exactly what this video is for. If you're new here, welcome. My name is Novah. I've spent over 15 years inside the banking industry as a credit risk professional. On this channel, I cover personal debt and lending through a risk lens, the side of the system most borrowers never see, but are always affected by. Everything I share here is financial education. It's not personal financial advice. My goal is just simply to help you understand how the system works so you can navigate it with more confidence. Now, there's one thing in particular I want to come back to later in this video, something that changes how the write-off conversation ends. Most people never get to that part of the story. But first, let us start at the beginning. So, what is this write-off? What does it mean? The word write-off sounds final. It sounds like closure, like the lender has drawn a line and walked away. But in banking, a write-off is not a decision about you. It's a decision about a number on a system. Here is what is actually happening behind the scenes. Lenders are required by accounting standards to accurately represent the value of their loan book. When a loan reaches a point where the lender no longer expects to recover it through normal means, through their normal processes, because of extended default, or even because the customer cannot be located and the loan is defaulted, or because formal recovery has reached its maximum limits, the lender removes that loan from its active asset register. This is called a write-off, or in accounting terms, a derecognition of the financial asset. This is an accounting step. It is an internal financial administration process. It says nothing about whether you still legally owe the money to the bank. Think of it this way. Imagine you lent a friend $100. They stopped repaying you. After months of trying, you write it off in your personal budget. You stop counting it as money you will receive. You tell yourself it is gone. But if your friend came to you the next day or even after several months and said, I can pay you back now, would you refuse the money? Of course not. The debt still exists, you just stopped accounting for it. Banks operate exactly the same way. The write-off is their version of removing it from the budget. The obligation, your obligation, still remains. So what happens when a debt is written off? Once a debt is written off, it does not disappear. It follows one of several paths. And understanding those paths is where this gets practically important. And the first path is that the lender would continue to hold it. Even after write-off, the lender may retain the debt internally through their own team or through an external collections agency. Write-off does not stop contact. It changes how the debt is accounted for. Those are two entirely different things. And the second part is that the debt can be sold. Yes, it can be sold. This is where people are often genuinely surprised. Lenders can sell written-off debts to third-party debt buyers, sometimes at a significant discount to the outstanding balance. And once a debt is sold, that debt buyer owns it outright. They can legally pursue the full outstanding balance. And just because a lender wrote off the debt and sold it does not mean the buyer is bound by that decision. And the third part is that the debt becomes statute barred. And this one is important, and I want to spend a moment on it. These are legal time limits on how long a lender can take court action to recover debt. These are called limitation periods. For example, in most states, the limitation period for unsecured debt is 6 years from the date of the last payment or last written acknowledgement of the debt. And after that period, the debt may become statute barred, meaning legal action through the courts is generally no longer available. And this is critical. Statute barred debt is not the same as a forgiven debt. The debt still technically exists. It is simply harder to enforce through legal means. And if you make a payment or acknowledge the debt in writing, you may restart that clock in some circumstances. And this is exactly the situation where getting independent advice before acting matters enormously. I will come back to that shortly. And now we have write-off, we have settlement, and we have waiver. 3 things. And this is where the real misunderstanding lives. These 3 words are not interchangeable. They're different. They describe completely different outcomes. A written off debt, as we have established, is an internal accounting step. The lender removes the asset from their books. The debt still legally exists. You still owe it. While a settlement is something totally different. A settlement is an agreement. It is a negotiated arrangement where you and the lender or you and the debt buyer agree that you will pay a specific amount, and that amount will be accepted as full and final resolution or settlement of the debt. The remaining balance after that agreed payment is then formally waived. This is the outcome most people are imagining when they hear written off debt, but it's not automatic. It requires a documented agreement, it requires payment, and it requires the lender or debt buyer to formally confirm in writing that the remaining balance has been waived. Let me just say that again clearly. You do not reach settlement by ignoring a debt. You reach settlement by engaging with it. A waiver is what happens to the remaining balance after a settlement is agreed and honored. The lender formally writes off their right to pursue what is left. This is documented, it's final, and it is completely different from the accounting write-off that we discussed earlier. So, to be precise, a write-off is what the lender does to their books. A settlement is what you and the lender agree to. A waiver is what happens to the leftover balance once a settlement is completed. One does not automatically lead to the other. And so what does this mean for your credit file? Now, here is the part I mentioned earlier that I wanted to come back to. Because even if a debt is settled, even if you pay, get the agreement in writing, and the remaining balance is formally waived, there is still something that does not automatically disappear. Default listings on a credit file remain visible for 5 years from date they were first listed. A resolved or paid debt is updated on your file to show the change in status, but the listing itself can remain for that full year period. This matters because lenders reviewing your credit file will see this history in your file. A resolved debt and an open debt are read differently. One shows a problem that was addressed, the other shows a problem that was not. But both are still visible during that 5-year window. And this is why people sometimes feel confused even after they have done the right thing. They've settled the debt, they got it confirmed in writing, but they still see something on their credit file. That is not an error. That is how credit reporting works. The history is retained. What changes is the status. And the worst situation where you can seek correction is if the listing itself was made incorrectly, wrong amount, wrong date, or without the proper legal notices being given to you first. In that case, you have the right to raise a dispute directly with the credit bureau or even the lender. So what can you do if you find yourself in this situation? If you have a debt that you believe has been written off, or you are not sure where things stand, here is a practical framework. The first step is that just find out who currently holds the debt. The answer shapes everything else. Is it still with the original lender? Has it been referred to an external agency? Has it been sold to a debt buyer? You have the right to ask and to even receive written confirmation of who holds your debt and the amount they say is outstanding on your file. And the second step is request everything in writing. Any settlement arrangement should be confirmed in writing, clearly stating the amount to be paid and that this constitutes full and final settlement of the debt. This protects you and creates a clear record. And the third step is that check your credit file. You are periodically entitled to a free copy of your credit report from each of the credit reporting bodies. Checking your file tells you what has been listed, when, and in what status. If something looks incorrect, you have the right to dispute it. And the fourth step is that you need to understand the limitation period for your debt if this concerns you, because it's different for different regions, for different products. If a debt is approaching or past that period, seek independent advice. Don't let fear push you into action without information. And as I close, I just want to say that a write-off is an accounting decision. Settlement is a separate negotiated outcome, and neither automatically clears your credit file. Understanding those three things, write-off, settlement, waiver, puts you in a completely different position to navigate this situation clearly, whatever stage you are at. If this video replaced some confusion with clarity, share it with someone who needs it. And subscribe, because next week we are going into something interesting. This is one you will want to see before you ever apply for credit again.